It's time for In the Money, Stock Market Action on AM 820 News. Here's Chief Market Strategist Gareth Soloway from InTheMoneyStocks.com.
Good afternoon, everybody. Great to have you with me on this Sunday, January 5th, 2014. A new year means new opportunities in the stock market. How many of you want to make 2014 extremely profitable, no matter if the market goes up or down? How many of you want to make 2014 a year to take control of your financial destiny? I'm going to help you do that. My goal is to pull back the curtain on Wall Street, telling you the truth. No more nonsense, no more hype from the general media and big institutions. It's time to learn what is truly going on so you can profit in any market condition in 2014 and beyond. And that's the bottom line, folks. So you're looking at a market, right? 2013, we saw amazing gains in the S&P 500, up 30% plus. And over the last multiple years, the S&P from the 2009 lows has gone up almost around 150%. It's been epic. But the key is that is coming to an end. And what we need to do as investors is to start looking about how to best handle a market that just doesn't go straight up. It's easy to make money in a market that just goes straight up. But what happens when we see a 10% correction or maybe more? What about when the next bust cycle comes in? And let's be honest, that's the type of market we are in. You have this huge run-up and then collapse, and then a huge run-up and collapse. So how do we not give back retirement income and huge amounts of savings when the next down move comes? And bottom line is, I'm a swing trader. And to briefly go over what swing trading is, it's being more short-term. You know, the media and institutions, they want you to be long-term investors. And I mean, listen, you know, long-term investing has worked for the most part. But if you think about where the market was in 1999, all right, the big bubble, we got the dot-com bubble, huge run-up, and then where the market is today, or even look at where the market was in 2007 before the financial crash and where it is today, you're not up that much if you're a long-term investor. Yes, the markets are at all-time highs, but we're just above those 2007 highs. So if you look at your return over the amount of time you're holding, it's really not that spectacular. So what I do is I swing trade. Swing trading is looking for shorter-term investments where you don't fall in love with the stock. And that's one of the biggest problems most people have. They fall in love with the stock. They say, oh, you know, Apple is the best company ever. I'm just going to hold Apple forever. And listen, maybe that works for some people. But I'll tell you something. Those people that bought near $700 a year ago or so, year and a half ago, they're not feeling that way. And this is why you have to look at the charts and keep it shorter term. The charts are what's going to give you the essence, the kind of magnification on what's going to happen, the insight. The media, they're going to tell you what is going to make you feel the best. You know, if you're greedy and you're kind of getting hyped up, well, the media is going to play into that. If you're fearful, the media is going to play into that. You got to understand the role of the media. We'll cover that a little bit later. But the bottom line is, in the money, stock market action, my goal here is to make sure that you see the truth of the markets. No more nonsense, no more hype. Understand the truth so you can make money no matter what. What would you say if I told you 90% of what you hear in the media from Wall Street is pure nonsense? In fact, more often than not, it causes the average investor to get emotional and be on the wrong side of the trade. This is the bottom line truth. All right, are there some good analysts out there? Yeah, there are a couple. Sure. But for the most part, analysts are upgrading stocks at all-time highs just before they fall off. And they're downgrading stocks like Hewlett-Packard late in 2012 when it was at its dead lows before it rallied 150% higher. You know, so you can't necessarily just take Wall Street for what it is or these analysts for what it is or the media for what it is. You got to start learning. And that's the biggest thing here, folks. I want you to get educated. Now, I don't mean education in the normal way. I don't mean, oh, learn what a PE is and EPS and, you know, earnings per share, all that kind of stuff. I'm saying just pull the curtain back and see inside of all this nonsense so you can make an educated decision for yourself. All right? And again, I'm here to give you that truth. I want to call out the institutions on their nonsense. I want to be Robin Hood of the investment world, fighting for that small investor. All right, again, the whole idea of In the Money Action is to be the champion for the small investor, to give you insight into the markets you're not going to get anywhere else. I want to give you analysis you won't hear anywhere else. I want to start making you think like a pro investor trader who will ultimately take control of your financial destiny and profit for life, no matter if the markets go up or down. All right, let's start out with some easy, tough love. And listen, I don't enjoy giving the tough love. I give it to my members at InTheMoneyStocks.com, in the chat room especially, where we day trade all day long. But honestly, it saves them money, and I know they appreciate it for that. So let's start out with the basics. First off, the first thing you have to recognize is the markets are not fair. All right? Institutions, they have billions of dollars to spend on computer programs that will trade in milliseconds. By the time you hear something good on the news and you go to your computer, you log into your trading account, and you're ready to buy, they've already acted 100 times on that news, and it probably ran up even before the news hit because, let's be honest, they get that news ahead of time. You know, yeah, it's not ethical that they get that. It's not right. But you know what? It happens, and it's been happening for years, 10, decade, whatever. You could probably go back to the beginnings of the markets, and it's been happening. It's just the nature of the beast. Now, how do we as individual investors compete? Right? How do we step up and actually make money? How did I make well over 100% trading this year? Well, I got myself educated. I started to think about what's really going on here. I studied charts. And that's the key. I want you all to go away from today's program thinking, all right, I just have to learn a little bit. And if I learn a little bit every day or every week, I'm going to start competing and beating, because that's the one thing the institutions don't have on you. All right? The institution, they have a brain just like you. That means you can compete if you know what to do. All right? So again, education. Right? And I don't mean, again, learning fundamental analysis. We're going to take it a step further. One thing I want to say about fundamental analysis, it's good. It's important, I suppose. But one thing I always tell my traders and investors at my website, InTheMoneyStocks.com, is that you have to understand that if everyone is using that metric to analyze a stock, then everyone is going to have the same idea as you and be long the stock. And if you're buying now on that metric, on that EPS, let's say, then you're going to be at the end of the rope. You're going to be at the end of the line. And that's just before it turns down. And that's why, in all fairness, when Apple was trading at 700 in 2012 and you saw analysts upgrading from 700 to 1,200 to 1,000 price targets, all the little investors were rushing in. The hype on them in the media was so intense. We just actually saw it recently with Twitter, which I thought was really interesting. But, you know, I'll talk about Twitter in a little bit. But when everyone else is so hyped up about it, you need to step back. Don't get wrapped up in that hype. Come back in and say, listen, let me just go to that chart. Holy cow. Apple's up, 100+% in the past year, maybe even more. Maybe it's not such a good thing that I chase it up here. All right? And again, it blows my mind because the average investor, and I love you all, but you have to take your financials more seriously, your investment accounts. People work all their lives to build these investment accounts of, 100,000, a quarter million, maybe $1 million plus. And they're so eager to just turn on the TV, hear what someone says, and jump in a trade. And it's like, all right, so you worked for that many years, your whole life, and you're just going to literally take that and just throw it in a couple stocks? How do we not get more educated? All right, it doesn't make sense to me, but bottom line is investing should never be gambling. All right, if you're going into a stock and you're looking at a stock and you're saying, it could go up, it could go down, I'm not really sure, that's gambling. If you invest correctly, the odds are in your favor. All right, with my members at InTheMoneyStocks.com, just to keep referring to that, but it's a great kind of referral tactic, is when we go into a trade, I really only like to enter trades that I feel I have an 80% success rate of winning. And if you have that type of success rate, all right, even if you have a 70% success rate, just think of the money that you can build over time. Okay? So again, the institutions, they're going to be against you. The markets are a transfer of wealth. I always remember that. The people that know nothing that are investing, they're going to get taken advantage of by the institutions that know everything. Now, intelligent investors and traders are up with the institutions. They're going to get the money transferred along. So what you need to do, each and every one of you, you need to start learning a little bit. And I'm going to help you through these in my radio show every single week. I'm going to walk you guys through. All right, we're going to take that and get you to the point where you go from being an average investor to the more advanced profiting investor. All right. So on that note, folks, I'm going to move into our first commercial break on 8:20 a.m. News. This is In the Money Stock Market Action one more time on 8:20 a.m. News Talk Radio.
This is Savannah Guthrie with an urgent story developing all across America. Despite having more than enough food available, there are nearly 16 million kids struggling with hunger. That's why the Feeding America nationwide network of food banks engages local communities in solving hunger by collecting surplus food, giving hope to hungry kids. But they need your help. Learn more at feedingamerica.org.
A message from Feeding America and the Ad Council.
You gotta check out the brand new Entertainment Evenings on AM 820 News, starting with the Dennis Miller Show, weeknights beginning at 7, followed by TMZ Live at 9, and Phil Henry at 10. A brand new evening lineup to go along with Tampa Bay's best news coverage. Stay informed all day. Get back in the evenings. Dennis Miller, TMZ, Phil Henry, and the news. It's a great evening lineup to go along with Tampa Bay's best news coverage. Now, weeknights beginning at 7, it's Entertainment Evenings on AM 820 News.
Okay, gang. So, chances are there'll never be an emergency ever again. But, just in case, let's talk about a plan.
Okay.
So, who's going to do what? Anyone? Yeah, okay, perfect. We'll figure it out as we go. So, who is going to grab the go bag?
What's a go bag? It is a bag we do not have that is filled with things we really need in an emergency.
Guess we won't have to worry about it then.
Ah, good point. So, we all know who to call if something happens then, right?
I'd have to call Jill, Devin, Melissa, Karen, and
Bruce. And I will try to call all of you, but Greg doesn't have a cell phone. Dad's phone will have a dead battery.
No doubt.
And Julie will be on the phone with Jill, Devin, Melissa, Karen, and Bruce.
Well, this is great. I am so glad that we don't have a plan.
I know.
Winging it is not an emergency plan. Make sure your kids know what to do during an emergency, who to call, where to meet, what to pack. Visit ready.gov/kids for tips and information. A public service announcement brought to you by FEMA and the Ad Council.
Now back to In the Money Stock Market Action on AM 820 News. Here's Gareth Soloway.
All right, guys. Good to be back here with you on this Sunday. Hopefully everyone's having a good one. Before we get into actual market projections and so forth, I want to just go over some of the shadier tactics that we've seen on Wall Street in the past few years. And I think this really shows us how we have to start thinking for ourselves. All right, number one, upgrades and downgrades. And I kind of mentioned this before in the segment, but let's look at specific instances. One that jumps to my mind was in 2008 when oil was running higher. And I'm sure we all remember it because we were paying so much money to fill up our gas tanks. But in 2008, oil got just about to $150. I mean, it was up tremendously. The pain was being felt everywhere. There was talk it could create this massive economic collapse, and whether or not it contributed in a major way to the financial collapse is still up in the air. But the key is, literally to the day it made its top, Goldman Sachs came out and upgraded it. All right, now, the average investor, when they hear that someone upgraded it, like a big name like Goldman or J.P. Morgan or some of these other ones, they take that as a buy signal. All right, well, if this genius over at this firm, who's a huge firm, is saying it's upgraded to a 200 price target, well, that must be a great opportunity to go long. Well, guess what? No sooner the upgrade was made, oil started to collapse. And we all know it went down to $30 or so from 150 or so. And the point of this is, again, I don't know if there's an ulterior motive here with these institutions. I don't know. All right, but what I do know is that you have to be wary. You have to think for yourself. If you looked at that chart, all right, if you looked at that chart of oil and you said to yourself, do I really want to pay up this much? You probably would have said no. So start ignoring institutions, especially when they upgraded highs and downgraded lows. Start looking at that chart. And again, both my partner and I at InTheMoneyStocks.com, and just to give him a big shout out here, Chief Market Strategist Nick Santiago, and you guys can all check out our website at InTheMoneyStocks.com. But bottom line is, we were all over that short. And when we hear an upgrade from a big firm like this at a high or a low or downgraded a low, we're almost always going the opposite direction of that call because we know the game by now. And I'm lifting that veil so you guys know this game. All right, and again, yes, could there be an ulterior motive? Did they maybe want to create some buying frenzy so they could sell into it? I don't know. Maybe the analyst was just poor, but it's hard to believe that a Goldman Sachs analyst could be that poor. All right, another situation I mentioned before, Apple at $700. All right, $700 a share. The amount of upgrades that were produced at this time were intense. I mean, I've never seen a stock upgraded so many times at a $700 area with price targets of $1,000 and so forth. And we all know what happened to Apple. Literally, these upgrades came at the highs, and the market or the stock itself collapsed back down to a low of 400. Now it's hovering in the 500 range and so forth. But keep your wits about you here. All right, another key thing is buy programs. All right, for those of us that have followed the market, and I live in the trenches, folks. I live and breathe inside the market. Every day I've got my 6 computer screens up with data flowing through it, and I'm just watching and kind of inside the market. And one thing that we've seen over the past year, especially since Ben Bernanke's been Federal Reserve Chairman, is that at particular times, the market has these buy programs. And it's so fishy how it happens because it's almost like going into a holiday, right? A good example is going into Thanksgiving of this year. All right, as the market was trading prior to the Thanksgiving holiday, the market happened to get this final push on both the S&P, the Dow, and the NASDAQ above major levels. All right, Dow got above 16,000. S&P finally got above 1,800. NASDAQ made new multi-year highs getting above 4,000. Now, you might say to yourself, okay, so the market's been good. No big deal, right? Well, think about it like this. All right, Ben Bernanke's sitting there at the Federal Reserve, and he's trying to stimulate the economy. And one way he's stimulating the economy is by printing, right now, $75 billion a month, but it was $85 billion last month. In any case, he's trying to get the consumer, the retail investor, to get out there and buy. Now, what's right after Thanksgiving? What holiday is coming up? Or obviously we have Christmas, but what big shopping day is right after Thanksgiving? And that's Black Friday. One of the biggest shopping day, if not the biggest shopping day of the year. So do you think it was in his best interest, in the institution's best interest, to push these indices up above those major levels? And remember, what happens when they go above these major levels? The media jumps on it. I can't tell you, had CNBC on, Bloomberg, all these, and everywhere you looked, it was all about Dow above 16,000, S&P above 1,800, NASDAQ above 4,000, and they were just pumping. Well, what effect does that have on the retail investor? Well, all of a sudden, oh man, this is a great environment. I think I can go spend that extra $300 on that TV now. All right, well, it starts that chain reaction. So I'm not saying that that's necessarily a bad effect. I mean, if you're long the market, you don't mind it, but you need to understand that it's not just a market you're dealing with here. And I don't mean to say it's not a market that we should trade, because we absolutely can trade and make money. But I want you to start seeing it for what it is. If you go back in history and you look at the market and you look at where things have been and when they get above key levels, especially in the last 3 years or so, you'll notice that right into major holidays like the 4th of July trading, big travel day, and Christmas and so forth, the markets tend to get above very important levels. And then again, what happens? The media starts pumping it. They just turn on their rotation and get out there. All right? A couple other things to keep an eye on here. All right? Understand the role of media. All right? Media here, folks, very important to see it for what it is. Now, I'm all for the media. The media is good. They tell us what's going on. They keep us informed. But we have to understand that someone like, CNBC, Bloomberg, and these other stations, they're there because people are watching. Right? So the way some of these media outlets stay online and on TV is by getting listeners, right? So let me ask you a question. If the markets were at all-time highs and you had, people in the media kind of talking it down and saying, and not being too bullish, are more people going to watch or less? Well, the answer is that if they're pumping, if they're getting you excited about how the market's ripping to new highs, more people are going to tune in. Well, why do they need more people to tune in? Well, because it all comes down to selling sponsorships, selling radio spots, selling TV spots. So the more listeners, the more viewers you have, the more they're going to sell. So understand that the media, they're trying to give you the key to all the markets and what's going on. But at the same time, they have to make sure that they get as many viewers as possible. So what they end up doing is harping on highs with greed and telling you, all right, this is a great market, and getting you pumped up. Well, when you get pumped up, you're more likely to put your money in because it's emotional. Oh, man, CNBC's hot. They're telling me all this good stuff. All right, and then on the other side, when it's bad, when the markets are at their dead lows, like in 2009, it was all doom and gloom. Well, that's when, you hear CNBC or any of these other stations, and it's all doom and gloom, and all of a sudden it's like, oh, man, well, maybe now I need to sell. And you sell at the lows. So what I'm saying here is understand that the media is good, but you need to understand that they're not there necessarily to give you the pure and simple correct analysis. They're trying to make sure that they have viewers. And I mean, listen, in all fairness, that's what I want here on the radio, too. I want listeners. But I think I can do it by giving you the pure basics, the honest truth, pulling back the curtain. And again, I want to be different. I don't want to be the same nonsense that's out there. That's not why I'm doing this. Right? If I wanted anything like that, I'd go somewhere else. But I want this show to give you the honest, bare-bones truth about the markets. All right. Next thing we're going to get into in the next segment, and I'm just going to start it right here, but we're going to get into what happened last week in the markets, and then we're going to project into the next week, into this coming week. I want you guys to be understanding of what happened at the end of this year, the last couple days, Monday and Tuesday this past week. Why was the market up the last couple days of the week? All right, and then at the same time, why was the market down a little bit in the first couple days of the new year? All right, in addition, I want to go over some possible trades for the next period, for the next couple of weeks that I like. All right, and again, you may not like to hear them. It may be short calls, maybe long calls. And just to quickly go over that, what's a short, right? Well, think of an investment. When you're making an investment in the market, you either need to bet on the long side or the short side. And you can do either one and make money. So most average investors, and nothing wrong with it, but most average investors don't really know what shorting is. Kind of sounds a little shady, right? But in essence, you need to know it because it's a way to make money when the markets go down. And there's nothing wrong with it. Nothing wrong at all. So definitely keep that in mind. All right? Couple other keys here. All right? I want to just briefly talk about options. I don't know how many of you know what options are, but the last little thing that I just want to point out about options is that the institutions sell a majority of options to the average investor. And the average investor will go on their E-Trade account, Ameritrade, wherever it is, and they'll buy some options. They'll buy some calls or they'll buy some puts. And puts, you're betting the stock is going to go down. Calls, you're betting it's going to go up. And you have a strike price. So let's say a couple things that we've noticed in the market, and this is from dealing with the trenches, being in the trenches, seeing this happen. What you'll notice here, folks, is that institutions, because they're selling a majority of these, they're taking a premium. So every time you buy an option, you're paying a premium to that institution. Now, the premium can be bigger or less depending on whether or not that options contract expires worthless. And what we've noticed here is that these option contracts will generally be driven right before Options X, which is the third week of every Friday, the third Friday of every week, or every month, I should say. They're expiring on that third Friday, and they get driven to the exact price, listen to this, that the institution will generally maximize their profit. So again, we talk about manipulation, some of the shadiness out there, and this is a prime example. I still remember it around the $500 level on Apple, where I was talking to my members, and we were just, it was early in the week. It was like 4 days before options expiration, and I just happened to say, listen, guys, mark my words, Apple's going to close at $500 almost to the penny. And sure enough, and again, how do the institutions know that? Well, they have these massive computer programs that are going to figure out where they max out on their profits. And sure enough, on that Friday, it went right there. All right, guys, I'm going to take another little breather here. You're listening to In the Money Stock Market Action on 820 AM News Talk Radio.
flight delays because of snow and ice affecting travelers nationwide are reported at airports, including in New York, Philadelphia, Chicago, and Detroit. More snow is falling right now in Chicago, with another foot possible on top of what fell days ago. More snow in Detroit now, too. The deep, brutal freeze is starting in parts of the Midwest, where at 4 p.m. Eastern Time, the Packers and 49ers play in Green Bay, Wisconsin, where it could be -2 degrees. Prompting advice from Green Bay Mayor Jim Schmidt.
We do encourage them to use the heated concourse, the atrium. We are giving out hand warmers to the fans who sit outside, as well as hot chocolate and hot coffee.
It's advice to the fans, not the players. As Congress comes back to work this week, Democrats are expected to push for renewing an extension of unemployment insurance for those out of work 6 months and for raising the minimum wage. A bipartisan panel working on that. Pope Francis says he will visit the Holy Land this coming May. Chuck Sievertson, ABC.
When I grow up, I want to be a new pair of blue jeans.
When I grow up, I want to be a kid's first computer.
I want to be a warm place on a cold day.
Football
I want to be a bike that races around the country.
I want to be a bench on a forest trail.
When I grow up, I don't want to be a piece of garbage. And if you recycle me, I won't be.
Give your garbage another life. Recycle. Learn how at iwanttoberecycled.org. Brought to you by Keep America Beautiful and the Ad Council.
It really keeps you abreast of what's going on in the current events.
The news and information you need.
It's important to stay informed so you know what's going on.
I have a long commute, so it's interesting to listen to. It makes me think.
You sound like you're kind of educated.
Continuous news all day.
I think people that are informed make good decisions.
Stay with us and stay informed.
It keeps you updated with the latest changes that are happening throughout the world.
News, information, traffic, and weather.
Tampa Bay's AM 820 News.
When you gotta know now.
All students in Florida deserve a safe learning environment at school, and it only takes one caring adult to make sure bullying doesn't get in the way. I'm Andy Ford, president of the Florida Education Association. Bullying has no place in our schools, and parents and adults have the power to stand up and stop the bullying, fix it, and prevent it. It doesn't have to be just the parent. All it takes is one caring adult to make all the difference. A student who is being bullied at school is being denied an opportunity to learn. So pay attention. There are many warning signs that may point to a bullying problem, such as torn clothes, unexplained injuries, loss of appetite, or a reluctance to go to school. Targets of bullying need an adult advocate. Take the pledge to be that adult at NEA.org/bullyfree.
A message from the Florida Education Association.
Here's Gareth Soloway with more In the Money stock market action on AM 820 News.
Hey, everybody. Welcome back. Great again to have you all with me on this Sunday. Next, what I want to do is go into market projections, and I want to first start out with what happened last week, and this is going to set us up, and this is not what the general media is going to tell you. This is going to be in-depth, key analysis that should really start opening your eyes. So let's go to last week. Last week we had New Year's, right? New Year's on Wednesday. The market was closed. Monday and Tuesday of last week, we saw the markets inching higher, especially on New Year's Eve. Now, number one, let's look at and understand why the market would go up into year end. Well, number one, you have to understand window dressing. All right, window dressing sounds like a weird term, but it's a market term that basically means hedge fund money managers and institutional money managers are window dressing their portfolios. All right, they're basically getting rid of their losers and buying their winners. Now, obviously, there haven't been a lot of losers out there, so they're probably not selling much, and they're probably buying a little bit as well. And they're definitely not selling their winners. Now, the key to window dressing is understanding this. All right. When you get your statement of your portfolio with that money manager, whether it's a hedge fund or mutual fund or anything like that, unless there's a strict thing they have to follow in terms of what investments, they're going to want to show you the best portfolio possible. They want you to see that this money manager had a huge amount of Google. They had a lot of, all these other stocks that performed and outperformed in this market. And believe it or not, it sounds a little shady, and it is, but they're allowed to buy a stock on the last day of the quarter, essentially, and put it in that portfolio. And then when you get your statement and you see what stocks they were holding, you're going to see that stock, and you won't know necessarily that they bought that on the last day. You're just going to be like, oh, I'm so glad they were holding on to, Boeing, or, oh, I'm so glad they had FedEx, all these stocks that outperformed. And so really what you saw towards the end of the year, those last 2 days of the year before 2014, which happened to be last Monday or Tuesday, you saw a little bit of window dressing and no selling whatsoever of positions, because they weren't going to sell a FedEx, and then you'd get your statement and it wouldn't have that great performing stock in it. Okay? So ultimately, year-end, markets get pushed up usually, especially if they've been strong all year because of window dressing. And then what you had was, come Thursday and Friday, a weaker market. Now, why would the market all of a sudden be weaker in the new year? Well, these money managers are not stupid. All right? Overall, they're very intelligent. And they looked at the charts just like me, and they said to themselves, holy cow, FedEx, Boeing, Google, Amazon, JP Morgan. I mean, I could go down the list. All these stocks have had such big rallies. Well, now I don't have to show my clients what I've been in for quite some time till the end of the quarter, till the end of the first quarter. I don't have to send the next account statement out. So therefore, let's take some profits, because in all fairness, these things are overbought. And then that's why you saw that selling right at the beginning of the year. And it really is quite something to think about. But in my perception of this market, folks, there's going to be trouble to come. I'd love to tell you it's going to be a perfect 2014. I'd love to tell you that the markets have another 30% upside. But honestly, I think you have to start thinking towards the downside and protecting yourself. All right? And protecting yourself is one of the things that we all must do better. All right? You have to look at those charts, and you have to turn off the pumpers out there, the hype out there, the institutional hype out there, and understand that they have a motive. They want you to buy high because they need someone to sell into. And again, yes, it's shady, but it's time it was said to the public. All right, now when you buy and a million others of you buy, it creates volume in a stock that they can sell into. And then they can distribute, and it's called distribution at the highs, just like at the lows it's called capitulation. Those are two key terms that I'm sure will come up quite a bit in the future. But again, understand that. Understand that you need to start stepping up and looking at the chart of a stock, and you never want to chase. All right, chasing is the worst thing you can do. I call it one of the biggest sins when I'm talking to my, members at InTheMoneyStocks.com. Now, just a quick little break here, folks. I just want to mention that if you'd like to call into the studio here and ask a question, we do have a number, 866-977-4820. Or if you feel more comfortable just emailing me, feel free to email me at Gareth at InTheMoneyStocks.com. First name is spelled Gareth at InTheMoneyStocks.com. And again, I can't guarantee I'll get to all the questions or callers, but I will do my best as we continue to talk about the market. All right, so now we've talked about last week. So you saw the run-up last week early, and then you had the New Year's break on Wednesday, and then you saw the profit-taking come in, and now you know why. All right, it's all about why the market went up there and then why it sold off in the beginning of the year. So what's going to happen now going into this new week? Well, the number one thing, and this is going to get into a little bit more chart-type stuff, so it's always better if you have the S&P up in front of you or you can look at it. I use candlestick charts for those of you that are aware of the types of charts out there. But one thing that I thought was interesting is that the market on Thursday, when we had the bigger down day, all right, we had a nice down day, and then Friday we did not break that low. All right, if you were going to be very bearish on the market right out the gate this week, you would have wanted to see the S&P 500 break the low from Thursday on Friday. That didn't happen. So what that means is we need to step back and hold ourselves in a little bit of a more neutral station here. All right, now one thing I want to just impress upon you, every investor out there always wants to be in a trade. I've always found that is that, if you have cash in your account, you're like, where can I invest it? Where can I invest it? And the one thing is to keep in mind, cash is a position too. It is a good position, because if you're unsure about the market and you don't want to be a gambler, then be in cash. Because cash, yeah, you're not going to make much money on it, interest rates and so forth, but at least you're not going to lose. And again, one thing I say to my members is, if you really are going to be a gambler, if you're going to be in the market and you basically think it's gambling, then instead go to the casino. At least you get free alcohol there, right? I mean, at least you get free drinks. Well, most places. Maybe not in Tampa Hard Rock, but in any case, go to Vegas, wherever. But the point again is investing should not be gambling. You should have a firm basis behind why you're doing something with multiple points. And then, all right, if it makes sense on the metrics and you look at the chart and it's not too extended, all right, you take it as a shot. Okay, now let's go into next week again. So number one, this coming week, the first thing I'm noticing is that we can't be too bearish because the market didn't break Thursday's low on Friday. All right, on that note, we're going to stay in a neutral basis for this coming week, and we're going to monitor whether or not we take out the all-time highs on the S&P that were made on New Year's Eve. All right, if you take out those highs, you might see a little bit more upside. All right, there could be a little bit more upside, but this is something new I'm going to bring to your table. And again, as we get into these chart-type things, it may be a little bit more tough for some of you to grasp, but I promise you, over the course of this radio show, over the next month, 2 months, 6 months, I will delve into everything, and then you can always call in and ask me questions to get yourselves orientated, in that right position to make sure you understand each and everything. All right, if you go back to 2010 on your chart, all right, and this is getting into some cool stuff, guys, a little bit more advanced, but I think you can all follow me, and I'll do my best to explain it. If you take the high from 2010 and connect a trend line to 2011's highs, you will notice that it connects through early 2013 highs perfectly. All right, what I did was I did a bunch of research, and I found that when the market has a trend line, or any stock has a trend line, and it's been around for a long time, and you have multiple years of data, and you're trading at all-time highs, if you get above this trend line, which we are above, there seems to be a band holding it in check approximately 3% above that line. And that's where we've been. And interestingly enough, if you go back and you look at your S&P chart this year, you get above and you go up about 3% above that line, and then you pull back. And then recently, going into the year end, we went above it by 3% again and pulled back. And again, these are upsloping trend lines. So what we have to keep in mind is, and this is going to be the key here, is that the upside is very limited because of this. Could we go up another 10 points in the S&P, 20 points? Sure. A little bit of upside is there. But the risk right now, without a doubt, is to the downside. And again, I'm neither a bear nor a bull, and I want to make that clear, folks. I'm not coming on here to be overly bearish. I'm a shorter-term investor, what we call swing trader, where I hold plays for 2 weeks, 3 weeks, 4 weeks, whatever it is. And I look to take small amounts on all of these. And I found that that's a much more profitable way to play the markets than looking for the home run. And again, all I have to do is refer you to the market and what we've seen in this boom-bust cycle we've been in since, it's been even before that, but we'll just call it since 99, 2000, the dot-coms, and then the collapse, and then we rallied all the way back up into 2007, then you collapsed again. I'd much rather be safer this way. I know it sounds like it's a lot more in-depth, and maybe some of you think, I don't have the time to do that. Well, you're wrong. You do. And listen, this is your money. If you don't want to take time to try to learn it, it's up to you. But honestly, we work so hard for our money, I would think we would all want to be educated and all want to get this under control and kind of have our financial destiny in our hands. All right, guys, so again, just keep that in mind. Now, a couple other things on the markets this coming week. We have to pay attention to gold. Why? Well, because gold had a significant reversal starting at really the end of 2013. All right, I don't know for some of you guys that caught it, but we made a new 52-week low on a gap down, and a gap down means that when the market opened, gold opened at a new low on the GLD chart, which is the ETF that tracks gold. And we saw a significant reversal that day, followed by 2 more substantial up days. Now, there's no way I'm a buyer up here after a 3-day rally, but I will tell you this, that 3-day rally on some volume there does tell me, at least in the short term, over the next month or so, that there might be some significant upside in gold. Now, down the line, if you ask me 6 months, a year out, I still think there's a good chance gold is going lower. All right, and just to give you a little reference point on my analysis on gold, basically when gold was trading $1,800 an ounce, I came out to my members and I said, guys, it's going down to $1,200. All right, and sure enough, not too much, a year plus later, we saw 1,200 and it pierced. And at that point, I said there's going to be a bounce coming, and we got a huge bounce. And then it came back into these double bottom. And a double bottom is the same level, that low at 1,200, or a little bit below 1,200, that we bounced off of, we now have retested as of the end of the year here, and now we're bouncing off of again. So it's just a technical, substantial support level. And again, support generally means you're going to bounce off of it. In any case, this is what I'm looking for this week on the GLD or on gold. If we can get a little bit of a minor pullback in the early portion of the week, I will most likely be initiating a long position in gold. All right, and that's a buy in gold. Long means a buy. Doesn't mean you're going to hold it for a long time. It just means I'm going to go long the stock, and I'll look for a good gain out of it, and then I'll get rid of it. Right now, I do have resistance on the GLD for those of you that are looking at charts at home at around the 122 level. So I would say this is what I'm looking for. And I'm looking at the GLD chart, folks, which, again, is the ETF that tracks gold. And I'm looking for a potential pullback to about the 116.50 to 116.75 level. And if we get that pullback, I'm going to be long and look for a target of about 121.5 to 122. So that's a decent gain. And again, that's swing trading, folks. You're looking for 5-10% gains, and you just want to rinse and repeat over and over again. All right? So that's what we're looking at for this week. I'm going to get into a little bit more in the next segment. But once again, folks, awesome to have you here with me, and this is what it's going to be all about going forward. We're going to start rocking the markets more and more, giving you the insight you need to profit. And again, glad to have you with me on In the Money Stock Market Action on 8:20 a.m. News Talk Radio.
This is a guided meditation on parenting. Find a relaxed position to let go of the time you left your daughter's blouse in the dryer too long and it shrunk 4 sizes, or when you donated her private diary to the public library. Deep breaths.
You don't have to be perfect to be a perfect parent. There are thousands of teens in foster care who don't need perfection. They need you. For more information on how you can adopt, visit adoptuskids.org. A public service announcement from the U.S. Department of Health and Human Services, Adopt U.S. Kids, and the Ad Council.
Great jobs with high income potential are somewhat difficult to find these days. This is a rare opportunity for any sales executive who enjoys working with clients by solving problems and growing businesses. News Talk Florida Digital and this station have a job opening only available to you if you have the skill set and want to earn a great income. Send your resume to hr@radiogenesis.com. That's hr@radiogenesis.com. If you think that you can be one of the area's top performers, then send your resume now to hr@radiogenesis.com. Genesis Communications is an equal opportunity employer.
Confessions of a Potentially Perfect Parent, brought to you by adoptuskids.org.
Okay, here goes. I know more about cooking dinner for a party of 12 than I do about packing a lunch for a 12-year-old. I know kids like things like PB&J, pigs in a blanket. Oh, and fish sticks. They do love fish sticks. Fillets I get, but sticks? What part of the fish does the stick come from? I know I can read a cookbook that'll tell me how to make a red wine reduction, but where are the cookbooks that can teach me how to cut the crusts off bologna sandwiches? Oh, maybe we can compromise on mac and cheese. Can you make that with brie? Everybody likes brie, right?
You don't have to be perfect to be a perfect parent. There are thousands of teens in foster care who would love to push your food around their plate. Call 1-888-200-4005 or visit adoptuskids.org for more information. This message brought to you by the U.S. Department of Health and Human Services, Adopt Us Kids, and the Ad Council.
Now back to In the Money Stock Market Action on AM 820 News. Here's Gareth Soloway.
Alrighty, guys, back on here, and a couple things that I want to go over. Number one, I have a couple questions that got emailed in, so we'll try to cover those at the end, but I want to get to this next important portion of this broadcast because I think it will help all of us in the new year maximize profits while limiting losses. And it's 4 keys to avoid losses to your account while making or on your way to making millions. First and foremost, risk versus reward assessment. All right, what do I mean by that? Well, anytime you go into a trade, you need to do a risk-reward assessment to see whether or not the reward you're going to get from that investment is worth the risk you're taking on. So, for instance, a good example would be if in 2012, Apple's trading at $700 a share, and you just looked at that chart and you saw that it was a vertical. In fact, let me just bring it up right here on my screen. I've got my computer screen in front of me here, and I just want to look at the type of move it had that year. All right? And in 2012 alone, it went from about $400 to $700. So you have to ask yourself, right, Am I getting Apple if I buy it at $700? Am I getting it on sale? Because, I mean, if you go to the store, if you go to the mall, aren't we all looking for sales? Well, yeah, we are. So what makes us think differently in the stock market? Why are you more willing to go long or buy a stock when it's up 100%? But if you go to the mall, are you really going to go and look for that pair of jeans that just got marked up 100%? I mean, do we do that? It seems so ludicrous when I put it in those terms, but we have to start thinking in those ways. All right? And again, think about it like a pair of jeans. If I go to the mall, I'm not looking for the jeans that just has the sign marked up 100%, come buy me. No way. What I'm doing is I'm looking for those pair of jeans that is discounted 25%, 50%, a good pair of jeans that I can get at a discount. So going forward, I want you guys to start asking yourself the same question. If you went to the mall and this stock happened to be a pair of jeans or a gallon of milk, are you going to pay up a huge amount just because you want it really bad? Or might you say, you know what? There's another trade around the corner always in the market. All right, I've never walked into, my day trading room and sat down and not seen at least a couple good trades throughout the day. And that's every single day. So there's no need to force a trade. Instead, do a risk-reward assessment. If it's up too high, step back. Honestly, I won't even buy something if it's up a little bit. I want dead low prices. I want to go to the store, or the market in this case, and get the best deal I can. Because you know what? When you're buying something low, you know you're getting it at a discount instead of risking, when you buy it high, a huge fall instead of just a little bit more upside. All right, number 2, stop trying to hit home runs. All right, and again, we're going to liken this to the large investors, the big boys, the institutions, because they don't try to hit home runs. They do what they do best, which is hitting singles and doubles, and that's what I do, and that's where I turned the corner as an investor and a trader. All right, in the beginning, I had a small investment account, and I felt like, oh, man, I got to find that stock that's going to double overnight or double in a month, and that's the way I've got to go, because I don't have a lot of money. That was the way I lost money. They strike out. I think about that. Well, guess what? In baseball, you strike out a bunch of times, and as long as you hit a few home runs, you're probably still getting a multi-million-dollar contract. In trading, in investing, you strike out, what's happening? You're losing money. Your money's going down the drain. You don't have the luxury to do that. So what you need to do is be that high percentage singles and doubles hitter. And by doing that, you can build your account. Now, granted, it's not going to double overnight. But what you'll be amazed at is that it will double over the course of 6 months or a year if you're consistent and if you do the right analysis. Good little story here. When I was a younger trader, trading and so forth, I was trying to always find the next big thing. And one day, I had $25,000 in my day trading account, which for day trading, and again, we're into day trading, but it relates perfectly to swing trading and investing. But one day, I started to just think small. I said to myself, listen, all I want to do is just make $100, $200 on a trade, and that's it. And, every day I would do 3 to 5 trades, and all of a sudden, I was, making money on 9 out of every 10 trades, 8 out of every 10 trades. And by the end of the day, I'd be up $600 or so. And I'd say, all right, I'm not making $1 million here, but $600 is not bad at all. And the next day, I did the same thing. And the next day, I did the same thing. And week after week, I did the same thing. And by the end of the month, it added up. And you have to start thinking long-term. Investing and trading is not a sprint. It's a marathon. And compare yourself to these large boys, these Warren Buffetts. All right, Warren Buffett's not buying a stock because he thinks he's going to make 100% overnight. He just wants to make a good income every year. And he does that 1,000,000 times over, and he just continues to make money. Start comparing yourself and acting like the big boys. Now, you may not have the money they do, but that's how they got the money they do. You have to start acting that way. All right. Next, never put all your money in one stock. That's the worst thing you can do. All right. I tell my members that you only want to put about 10% of your portfolio in one stock. Now, why do I tell them that? Well, because eventually we all have losers. I'd love to say I'm a perfect trader, but I'm far from. I have losers. Now, I still bat 70, 80%, but I still have losers. If I put all my money in one of those losers, I could get crushed on it. By limiting your exposure and diversifying, essentially, you're going to limit your losses, and as long as you're batting a high percentage, the money's going to start to roll in. All right, very, very important there. Next up, discipline. And discipline kind of goes back to what we were talking about a little while ago. You can't chase a stock. All right, you can't. All right, once you're chasing, you're in that group that is generally going to lose. Now, not always. Listen, a stock can keep going up. We've seen crazy moves in the 3D printing stocks and so forth, but you can't be buying at these highs. All right, remember, there's always another trade around the corner, and if you're buying at highs, you're the last one in the door. Think about it like this, right? The market has a certain amount of buyers. Let's just talk about it like there's 10 buyers. 10 buyers in a small market, and 2 of them are institutions, 2 of them are pro traders and investors, and then the rest are average investors. Well, if you have a stock and the institutions get in first, which they almost always do. They're the ones that when the biggest fear is out there, they're going to buy. Same thing with me and the other pro investors. We're going to buy when there's most fear because we're not taking emotion into account. We're looking at it logically. Well, if we're in the stock and then you have those 6 other investors or so that are just average, well, when the stock is running up because we're buying and then all of a sudden they jump in, well, who's left to buy? I mean, ask yourself that. And again, this is on a minor scale, but it applies to the whole trading world in any stock. Because when the little guy is chasing, when the average investor is chasing, who's going to buy after them to push it up? Because that's what it is. I mean, stocks go up because there's more buyers. But once those later buyers, those average investors get in, they're the last ones to get in. Well, then the institutions are selling into it, and all of a sudden, without buyers, that stock is going down. You got to remember that, folks. So discipline is unbelievably key. All right. We're just going to take a couple questions here to end the trading day, and I'm just going to read off a couple emails that I got. Jason C. in Tampa, will another flash crash happen, and how do I avoid being caught in it? That's a great question. We all remember the flash crash where the market stumped out very, very quickly. Now, supposedly they put in safeguards to keep it from happening. Honestly, it will happen again. All right, the market is more computerized than ever, and what happened with the flash crash was, they've made a lot of excuses about it and looked into it, but really you have these high-frequency trading programs that were created by institutions, and when one starts selling, they all start selling, and it's so fast and furious that it's just going to crush the market down. Now, the key is this, that as long as you educate yourself, you really should never be buying at huge highs anyways on the market before that goes into effect. And if anything, going back to the flash crash that happened years ago, my partners and I were actually short the market. So I still remember being long QID, which is 2 times short the QQQ, the NASDAQ 100, and that thing ripped. And I made a lot of money on it, as did members at InTheMoneyStocks.com. So the key is we just have to rock and roll this market. All right, guys, it has been a pleasure. See me next week. Join me here. Loved being here. And again, this is In the Money Stock Market Action on 820 AM News Talk Radio.